Hi, welcome to Dig Into China. I'm Dong Xiong. Recently, an article by Bloomberg discussing the issue of the depreciation of the Chinese yuan has attracted a lot of attention, causing significant repercussions in mainland China. The title of this report is Yuan Devaluation Debate Surfaces as Traders Wait the Next Foreign Exchange Shock. The Chinese yuan's exchange rate has declined from approximately 7.0 at the start of the year to around 7.25 presently. This prompts the question, will this downward trend persist, and if so, to what extent throughout the remainder of the year or mid-year? According to Bloomberg, the Chinese Communist Party has prioritized defending the yuan's exchange rate as a higher priority since last year. However, Beijing appears increasingly ineffective in this endeavor, as a recent uncommon move by the CCP Central Committee suggests mounting pressure for yuan depreciation. On April 16th, for the second time in a month, the CCP attempted to relax its control over the yuan, reaching a significant milestone at the psychological threshold of 7.3 yuan per US dollar. A recent report from a leading US bank suggests that shorting the Chinese yuan exchange rate is currently the favored move among investors, with expectations that the onshore yuan dollar rate could drop to a range between 7.3 and 7.4. Since the end of last year, Beijing has effectively set a bottom line for the US dollar Chinese yuan exchange rate at 7.32. In late March, market shock ensued when Beijing reduced the yuan's midpoint, but official support for the yuan quickly resumed. On April 16th, Chinese state-owned banks actively sold significant amounts of US dollar in the onshore market to prop up the yuan. However, despite these efforts, it's anticipated that the yuan will decline to 7.3 against the US dollar by the end of this quarter. Bloomberg's article presents a crucial insight. While it doesn't offer a long-term forecast for the extent of the Chinese yuan's depreciation, it does provide a near-term projection. According to their analysis, by June 30th of this year, which marks the end of the first half, the yuan is expected to drop to 7.3. Many people may ask, will the Chinese yuan fall below 8? I'd say it's likely, but I can't guarantee it will happen within the next century. That wouldn't make any sense. Let's first understand how the yuan initially breached the 7 mark. During the administrations of Hu Jintao and Wen Jiabao, the yuan's exchange rate remained in the 6s. So when did it start to surpass 7 and stabilize above that threshold? That was due to actions taken by the Trump administration. In 2018, Trump initiated a trade war. On August 1st of that year, coinciding with China's Army Day, the Trump administration announced a 10% tariff hike on $300 billion worth of Chinese imports into the US, marking the official start of the trade war. The yuan's breach of 7, that happened just 4 days later on August 5th. So is the decline in the Chinese yuan's exchange rate solely due to the 10% tariff increase? Not exactly. During the US initiated the trade war, currency manipulation was also used as a threat. After the yuan broke the 7 mark on August 5th, the US swiftly labeled China a currency manipulator that same evening. What does this imply? It suggests that the Chinese government intentionally allowed the yuan to depreciate. The underlying message was clear. If the devaluation continued, tariffs would be increased to offset any price advantage gained. Hence, during the Trump-era trade war, both China and the US tactically agreed that it was acceptable for the yuan to depreciate to 7, but if it fell to 8, consequences would ensue. That's how the yuan broke the 7 mark during those times. Simultaneously, it's understandable why the yuan stopped at 7 and it didn't continue to depreciate further. Aside from political considerations, the Chinese Communist Party is hesitant to let the yuan devalue excessively. Allowing unchecked devaluation could lead to uncontrollable consequences. While the CCP aims for a moderate depreciation to bolster its foreign trade, it refrains from excessive devaluation. Hence, when the United States provided some leeway, China adhered to that range without exceeding it. Understanding how the yuan surpassed 7 provides insight into how and when it might breach 8 in the future. According to consensus on Wall Street, the yuan breaking 8 hinges on future U.S. policies towards China. Following the U.S. elections, if the new administration imposes additional tariffs on Chinese imports, the yuan could surpass 8. The Financial Times once offered a forecast if, for instance, Trump were to become U.S. president and enact his proposal to raise tariffs on Chinese goods from 10% to 60%. The yuan's exchange rate would likely plummet. They conducted a simulation and estimated it could reach 8.5 yuan per US dollar. While the possibility of Trump's suggestion to raise punitive tariffs to 60% is unlikely, increasing tariffs from 10% to 30% is quite plausible. Even with a more moderate increase to 30%, the likelihood of the yuan breaking 8 would be considerable. This is because the yuan's exchange rate is influenced by factors beyond just tariffs. If US-China relations worsen, other complications could arise. Thus, based on this analysis, predicting when the yuan might breach 8 becomes more straightforward. There is a significant probability of it happening within the next 5 years. Many economists are drawing parallels between China's current real estate challenges and Japan's lost decade in the 1990s. They argue that both scenarios are characterized by debt-driven economies, resulting in eventual debt collapse and a prolonged economic downturn. However, I hold a different perspective. Comparing today's China to 1990s Japan overlooks significant differences. China's large population size and greater economic resilience set it apart. Additionally, one crucial aspect often neglected in these comparisons is the role of currency wars. While Japan faced a decade-long economic slump due to its debt collapse, many fail to consider the currency war initiated by the United States against Japan. Thus, while there are similarities between China's current real estate bubble and Japan's bubble burst leading to the lost decade, the absence of a currency war, particularly one instigated by the United States against China, is a notable distinction. Let's revisit how the United States initiated a currency war against Japan back then. A significant event was the signing of the Plaza Accord in 1985 between the two countries. Following this agreement, the yen value appreciated by more than 5% annually, while Japan experienced annual real estate price increase of over 15%. Meanwhile, Japan's nominal GDP growth was only around 5% during the same period. This divergence indicates that the bubble economy was increasingly disconnected from the real economy, to the point where Japan's per capita nominal GDP surpassed that of the United States. By 1989, the Japanese government began tightening monetary policy, triggering the sudden collapse of the real estate bubble overnight. This led to a substantial accumulation of bad debts for banks, plunging Japan into over a decade of economic decline. When comparing China's current economic predicament to Japan's past, the glaring real estate bubble stands out. Yet, the crucial catalyst of a currency war is still missing. But could a currency war erupt between China and the United States? Recent discussions surrounding Blinken's and Yellen's visits to China revolve around this very topic. Yellen focuses on addressing overcapacity, suggesting that curbing it would necessitate yuan appreciation. Blinken, however, demands China cease supporting Russia's military industry, threatening to exclude Chinese banks from the SWIFT system as leverage. Being expelled from SWIFT is a potent currency war tactic that would greatly devalue the yuan. While Yellen pressures for yuan appreciation, Blinken's stance aims to depreciate. If either approach spirals out of control, or if one is significantly escalated, it could spell disaster for China's currency system. Thus, the prospect of a currency war is looming, with the United States positioning itself on multiple fronts, preparing to launch such an economic battle against China. This situation poses a severe threat to China. When considering the future shape of a potential currency war initiated by the United States against China, the predominant form might lean towards either forcing the yuan to appreciate or depreciate. I believe that the forthcoming currency war between the two nations will echo the blueprint of the recent years, where the yuan's exchange rate stabilized around 7. On one hand, the United States aims to restrain China's exports by hiking tariffs and limiting its access to foreign reserves. Conversely, the US seeks to prevent excessive yuan depreciation, as it could undermine the effectiveness of tariffs and invite accusations of currency manipulation. Future currency warfare is likely to persist along these lines. One aspect involving decoupling, risk mitigation, and curbing overcapacity to diminish China's foreign exchange reserves, and the other aspect focusing on preventing yuan's excessive depreciation. Some individuals argue from an anti-communist standpoint, suggesting that devaluing or causing the collapse of the yuan would be advantageous. However, in reality, depreciating or collapsing a currency is a relatively straightforward task. Yet, from the perspective of economic stability and competitiveness, simply devaluing a currency doesn't solve all problems. Zimbabwe serves as a prime example. Despite its currency experiencing significant depreciation, the political regime remained largely unaffected. Thus, a country's currency security primarily hinges on its economic fundamentals. The US strategy isn't solely focused on targeting the yuan. It encompasses a comprehensive approach to economic competition. Presently, the preferred tactic is to compete in economic development. If targeted successes are achieved in this arena, then implementing significant yuan devaluation as a subsequent step would become much easier. In the upcoming years, the trajectory of the yuan may involve a downward trend, but it's improbable to see it plummet out of control or undergo a significant crash similar to Japan's experience. Consequently, current projections on Wall Street indicate a decline to approximately 8.5. From the perspective of the United States, while curbing Chinese exports, permitting only a limited depreciation of the yuan aligns with maximizing American interests. Thank you for watching. Please like, leave a comment, and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.